aspects. We've had more broad-based participation from sectors in terms of contributing to total performance, or that breadth measure that we think is really important for capturing alpha. We've had more broad-based participation at the sector level in the credit market year to date versus for sure what you've seen in the S&P 500 compared to the equal weighted index in the equity market. I think that continues. And one of the really interesting things that we've seen is that it's somewhat easy to say, well, perhaps the total return contribution tracks the index weight in the credit market. We've seen sectors that were punching above their weight in the credit market, like energy, like leisure and lodging, like retail in the high yield market in particular, that have really outperformed relative to what their index weight would suggest in terms of contributing to total return performance. And in this environment where dispersion is high, where we do expect an uptick in defaults as the cycle continues, we're expecting below trend growth, as you know, sticky inflation. We do not expect rate cuts. We expect a higher cost of capital environment. We think that that dispersion will continue to drive alpha generation, but we hold on to this point that breadth is really important for total return contributions in credit, and we think that that pattern will continue, unlike perhaps what we've seen year to date in the equity market.
Amanda, I want to talk about return potential in credit just a little bit more, because you're not the first person, you won't be the last. I've heard from a lot of people this week from fixed income, throw cold water at what's been developing in equities. Mark Kiesel of PIMCO said this earlier this week to me. He said, we haven't seen this return potential in bonds in more than a decade. We don't think this yields will be there in a year from now. Amanda, just what is this setup like from your perspective? Can you describe it?
For sure. So I think, walking into this year, we did have and we still do have a really attractive opportunity across various subsets of fixed income. All-in yields are at levels that we haven't seen in some cases over a decade. Again, the credit market is very nuanced, so it depends on what region and asset class you're looking at. But the point that we've made recently is that a lot of that heavy lifting in terms of getting yields, all-in yields up to those very attractive levels has been done by the risk-free rate. And in some areas, spreads are actually still quite snug. The U.S. high yield market in particular is below the median of the post-financial crisis era and the past 2 decades. And so we think that it's reasonable to expect a rebuild of risk premia in some of these markets, so meaning spreads would go wider. And so that's something that we're definitely watching for. But to your point, it's a very attractive opportunity set in fixed income for especially all-in yield buyers. And we think that that probably persists because, again, I think the bar for the Fed and other central banks, frankly, to cut rates is quite high, and we continue to have that view. And we're seeing it from central banks around the world, really, just because inflation is so persistently elevated, and I think it will take time for that to come down. The other point that I think we've been talking a lot with investors about has been how to diversify portfolios in the environment that we do have this higher for longer interest rate environment, and we're firmly in that camp. And we've been looking to alternative assets, specifically private debt, as a really good way for investors to capture some of that floating rate exposure, even though we may be very much towards the end of the rate hiking cycle, but still build in some of those structural protections that we think will be really important as we head towards a period of below trend growth, sticky inflation, restrictive monetary policy, so a really challenging growth, inflation, and policy mix with a higher cost of capital for an extended period of time added to that.
Amanda, is that below trend real GDP? And will nominal GDP continue to be quite high, like it has been over the last couple of years? And with that in mind, how do you think about what that means for the performance of credit? Because if I speak to equity investors living in a nominal world, they like the idea that nominal GDP will stay high. Can I get your comments on that and what that means for credit?
For sure. Yeah, it's a great point. So I think the inflationary backdrop has boosted nominal earnings, but at the same time, you're also having inflationary pressures on the cost of goods sold, the cost of capital. And so that's something that investors are very mindful of. And on the corporate side, whether you're managing to your equity stakeholders or your credit stakeholders, you really do need to manage that kind of nominal growth in the costs that are eating through your margins. And what we've seen is that even the higher quality aspects of credit, so to your point on how that flows through, the higher quality rating buckets in the credit market haven't been immune to those pressures on margins. In fact, for various points of this year, whether you cut it by spreads or excess returns or total returns, the high end of the high yield market in some instances has been outperforming the low end of the IG market. And so it really just speaks to the point that your top line can get a boost from inflation, but at the end of the day, it's the bottom line profit that really matters. dollars, and those inflationary pressures, specifically wages, but other parts of the expense line items as well, are really inflated because of that inflationary environment. And that's something that corporates are going to need to handle for an extended period of time. We're seeing it in the cost of capital, but then we're also seeing it in the regular way earnings. And I think it's been striking that the higher quality markets, parts of the market, haven't been immune to that.
Interesting. Amanda, thank you. As always, great note, by the way. Really interesting read. Amanda Lanham there of BlackRock on the latest in credit, the leadership profile of credit versus, say, equities right now. Coming up, you've heard a lot about this, US exceptionalism.
The economy is far more resilient, as you know, than is appreciated. What's actually driving the market is earnings expectations, which have generally been improving over the last few weeks.
That was Neil Dutta of Renmac. Do you remember the Europe story? The boom over in the Eurozone? Well, arguably, Europe was in a recession Q4, Q1, and now it's the return of exceptionalism in the United States of America. That conversation up next.
The economy is far more resilient, as you know, than is appreciated, and that's going to mean that the Fed's ultimately going to have to do more than what's priced. What's actually driving the market is earnings expectations, which have generally been improving over the last few weeks. Earnings are up, and that's why the market's up.
Neil Dutta of Renmax still optimistic. The latest comments adding to these just last week. The main reason for optimism on the US economy is that inflation, especially prices for commodities, is easing more rapidly than the labour market. As a result, real incomes will expand, supporting consumption. So for some at least, the US economic expansion remains on track despite constant calls for a recession. Meanwhile, in Europe, the Eurozone economy is suffering the mildest possible contraction. According to revised data for the 20-nation economy, shrinking 0.1% between January and March, adding to a fourth quarterly decline of the same magnitude and leading to the first 6-month contraction since the pandemic. Let's get to the team coverage. Bloomberg's Mike McKee, Guy Johnson. Guy, straight to you. Are the Europeans calling this a recession or doing that US thing of the last 12 months and arguing about it?
This isn't a recession. Of course it's not a recession. Who cares, John, whether or not the economy was point up or point down? What does matter is that this was a period of stagnation, let's call it that, in which core inflation, John, either accelerated to the upside or was incredibly sticky. We had a mild recession and inflation didn't come down. Core inflation didn't come down. And that's the way to watch this. Yeah, we were down a touch, but it could have been significantly worse. We had the energy crisis that didn't turn up. We had fiscal policy that was very expansionary. So yes, the numbers could have been worse. We already know that. What is important about this number is that it coincides with a period of very strong inflation. What kind of a recession, therefore, are we going to need to bring inflation back down to target for the ECB?
Mike McKee, is that the smell of stagflation going into next week in the ECB?
Yeah, well, it certainly could be, but the question is in the United States, how different are we from what's going on in Europe? Well, one thing is the central bank has a dual mandate, not just inflation, which is still double what they anticipate or would like to see in their mandate, but we also have an employment mandate. And we got some news this morning that suggests maybe some cracks in that. Jobless claims rise by 28,000, the biggest increase in some time, to 261,000. Is it a harbinger of what's coming in the labor market, or is it a one-off like the last time we saw a bit of a spike? That's going to be a question the Fed doesn't have an answer to, because the next claims numbers come out on Thursday of next week and the meeting is Wednesday. We're also expecting to see some new projections from the Fed for growth and for unemployment and for inflation. Here's the latest Bloomberg economic survey. While we do have predictions for slowing growth, economists surveyed by Bloomberg, as you can see there, that white line, think we just won't go under the zero line, unlike the Europeans. But look at the bottom there. They're also predicting a 65% chance of recession. So on the one hand, they're predicting recession. On the other hand, they're saying we're not going to contract. I'm not sure anybody really knows what's going to happen here in the States.
Hey, Guy, you get the final word on what's going to happen over in Europe. The ECB set to hike next week. What's the what next from the ECB after that?
Well, the what next after that, probably, John, is another rate hike. Inflation is proving to be incredibly stubborn. To Mike's point, they have a single mandate. To use Jean-Claude Trichet's phrase, there is a single needle in the compass. They need to get inflation back down to target to retain credibility. It is not coming down. The economy is stagnating and it's not coming down. They need to push harder, seems to be the message. You get hearing it consistently across the board from most members of the Governing Council. So what next is another rate hike. The question is, do they then pause? And do we then end up in a scenario where they pause maybe for 1-2 meetings and then they have to come back, a bit like the Bank of Canada and a bit like the RBA? That is the challenge that I think central banks are dealing with right now, and they're watching very carefully what is happening elsewhere.
Agreed. That's the conversation of the last 24 hours in a much more pronounced, bigger way. Guy Johnson, Mike McKee, looking forward to the coverage with you guys a little bit later. Guy and Alex Steele coming up in about 7 or 8 minutes' time. Consensus trades this year. We've been talking about it on this show over the last few months and just getting eaten alive. We came into 2023. We don't like tech. Tech ripped. We don't like the US dollar. The dollar over the last couple of months starting to show some strength. We think we're going to get rate cuts, then we have to price them out. We love Europe. We love Europe. Do you still love Europe? Let's get you some sector price action. Here's Abby.
Well, John, we're looking at a tiny loss for the S&P 500 at this point, but much bigger moves beneath the surface, especially to the downside. We have real estate down 1.6%. The financials down 0.75%. Materials, industrials both down more than 0.5%. To the upside, consumer discretionary and technology. So after yesterday's big sell-off, we have a little bit of a bounce back for the mega cap techs. Let's take a look at this rotation that we're seeing over the last week, because it is pretty interesting that you have small cap cap up 6%, helped out by the banks up by about the same amount, but the Nasdaq 100 and the stocks, well, they are both lower.
Abby, thanks for that. Coming up, your trading diary. Bonds whipsawed over the last 24 hours, stuck between surprise rate hikes from the Central Bank of Canada, pushing yields higher by almost 8 basis points. About an hour and 25 minutes ago, jobless claims in America surging, pushing yields back down by about 7 basis points to the front end. Equities not doing much at all, down about 0.1%. That's the price action. Let's get to the trading diary. 11 a.m., about an hour from now, Prime Minister Rishi Sunak sitting down with President Biden at the White House. Salesforce holding its annual general meeting at 2 p.m. Next week, UBS could complete its Credit Suisse takeover as early as Monday. CPI on Tuesday, PPI on Wednesday, then a main event Wednesday afternoon. It's Chairman Powell and a rate decision with that news conference too. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, June 8th. Here are the top market stories that we are following for you at this hour. Fire chokes New York. LaGuardia grounding inbound flights for a few hours as smoke from Canadian wildfires blanket New York in unhealthy air and paint apocalyptic scenes. And GameStop, stock plummets as Q1 sales fell short of estimates and the company fires its CEO. And go big or go small. Russell 2000 pretty much goes nowhere. Tech continues to rally as jobless claims rise. The curve bull steepens, but is it time to go with some small caps? We'll break that down. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, in terms of a catalyst for the market, that's definitely next week. That's CPI, that's the Fed.
Yep.
The catalyst right here is most definitely the weather.
Everybody's talking about it. It's the only story, isn't it, that everybody's already focusing on. Yes, we can look at claims. Yes, we can look at GameStop. Yes, we can look at whatever just dropped on the studio floor in New York. But something clearly is changing here. You've got a weather situation that is bringing into sharp relief, Alex, the fact that not only do we need to spend on making sure that we kind of mitigate future environmental disasters, we need to start maybe spending money on dealing with the here and now.
Yep.
And I think that's going to be a really interesting question in terms of the impact it's going to have on the economy, on inflation, on where people live, on demographics. There's a whole range of factors that I think we need to bring into play here.
So to this point, we're going to get updates, I feel like this, very quickly. The New York Health Department saying the air quality improves, but it improves to 209. Anything over 200 is considered terrible for everybody. So that's a pretty sad improvement. And that the quality air for the level is still at, quote, very unhealthy levels. And there's a lot of lack of clarity as to when it's actually going to clear up.
Okay, so just describe, what is it like? We're sitting over here in London. We have no idea. We're seeing all these pictures. As you say, it looks a bit apocalyptic. What is actually, can you describe to me what it's like going outside?
Oh man, I mean, I wear 2 masks outside and I can still taste smoke in my mouth when I get home. It feels like there's no place safe from it because if you open any door, it kind of comes in. My clothes were reeking as of yesterday. I appreciate this picture doesn't necessarily feel like it's doing it justice. It maybe just looks hazy, but outside, I mean, for me at least, it is, it's really terrible and it's very distressing. My parents haven't gone and left the house in 3 days. I'm telling them not to leave, all the windows closed, air conditioning on. It's a very scary time there.
Absolutely, and it comes so soon after us all having to understand that we need to wear masks for the pandemic. Now we're wearing masks because of air quality. The two are unrelated, but in some ways speak to a new world that potentially we are going into. Our question of the day, therefore, a fairly straightforward one. What needs to change as New York chokes? Joining us now to discuss on the economic front, Mike McKee. Brian Sullivan joining us to give us an idea of what does need to change. Mike, I'm going to sort of come to you first. We find ourselves in a situation where clearly we're trying to spend a lot of money on preventing future disaster, environmental disaster. Maybe this is an example of where we need to spend to mitigate the effects of it right here, right now.
Well, there's not a whole lot you can do. I mean, you ask what can change, Guy. What needs to change is the direction of the wind. There's a low-pressure zone over Canada that's pushing all the smoke our way. If that goes away, the smoke will still be there, but it'll be higher in the atmosphere, and it would go east over less populated areas. Now, I'm being somewhat facetious, but there isn't much you can do about wildfires. The environment is so dry right now across much of the United States and Canada that this is going to be an issue all summer. Long term, obviously, you want to try to prevent any more global warming. I mean, we're getting this with what we've got.
Yeah, but sure, Mike, I hear what you're saying, but are we in a situation where, yes, we're trying to prevent it in the future, but do we need to start thinking about protecting the population right now? We spent a great deal of money during the pandemic preventing the pandemic having an impact, killing people, debilitating people in the United States. Are we going to end up having to subsidize the population so that the population can manage this in a more proactive way?
Well, there isn't, as I was saying, a whole lot you can do about wildfires, but other aspects of global warming are calling for a lot of mitigation, especially anything to do with water, hurricanes, and flooding from that. Yes, there's got to be some spending on that. We don't know exactly what will work as a universal fix, but talking about putting sea gates in, raising the homes and businesses off the water, and not building on the water anymore, which is a controversial issue here in the U.S. But the flood insurance program has given people the security to think that they can build anywhere, and we keep having to rebuild, and at some point that's got to stop.
So let's get to the facts on the ground, Brian. You're the weather guy, basically. You're in Boston, so the air quality is much, much better. Brian, what do we know about the wind pattern? When is this going to get better here in New York?
Right, so the best guess right now is Monday, Tuesday is when things will really break out and move off shore. So until then, you know, New York is going to be in the path, and so is Western Pennsylvania, so are the Great Lakes. Depending on each day, which way the wind is blowing, all those places can get hit.
Oof.
Yeah. The real question, Alex, is does this become a regular occurrence? Because that's what's going to change behavior. You talk about the fact that your parents are going to be indoors and they're going to be turning the air conditioning on. Does that air conditioning have an air filtration system built within it? Are we going to need to retrofit buildings so that they do have that kind of filtration system available? What kind of a spending story is going to come with that? Are we going to have to be seeing that really up and down the East Coast? I'm wondering what the long-term effect of this is. This feels like it's a wake-up call right now, but if you want to manage your journey through this environmental shift, presumably that's the kind of thing you're going to have to be doing.
Or when you look at, say, the IRA and all the billions that are going to be spent on the energy transition and greening stuff, do we also need stuff in the bill to do things like that, or find ways to put out fires more effectively, or deal with the fact that it's so dry and manage that part of the equation as well? Brian, just another quick one for you. I mean, Monday, Tuesday, you should have seen me in the chair when you said that. I was like, oh. Walk me through, though, how we put the fire out, because great, okay, maybe New York gets better Monday, Tuesday, but as Mike was pointing out, it goes somewhere else. It can always come back here too. We still can't put out the wildfires.
So that's one of the insidious things about this. I mean, you have vast forests up there. They're very remote. They're very hard to get to. There's only so many resources that Canada can put to them. The United States is sending up 600 personnel to help fight the fires. Other folks are coming in from all over the world to help fight the fires. So, you know, these fires could burn all summer, and every time the wind shifts, we could be right back here again. And then speaking to your larger point, you know, New York is going through this now. San Francisco went through it a couple of years ago. Singapore went through it a couple of years before that. This is becoming something that happens over and over and over again in the major metropolitan areas.
Brian, just in terms of, therefore, how you plan to deal with this, what is the process you think the big cities like New York are going to have to go through? If this becomes a more regular occurrence, if it becomes a more regular occurrence to San Francisco or Singapore or wherever else it's going to be, how do cities need to manage their way through this? What can you do to protect yourself in the here and now to deal with the kind of smoke that we're seeing?
Well, I think first off is education for people, and just tell them, you know, this is a serious situation. The smoke can do damage to you, especially if you have any kind of underlying respiratory issues or pulmonary issues. But in the longer term, you know, it's the climate change that is behind this. You know, climate change sets the table. Weather is just delivering the meal. And if it's not just the fires, it's also sea level rise, heat waves, the extreme storms in the wintertime. So, you know, we're going to see more and more of these extreme events as we go on.
Well, one thing, Guy and Alex, that should be mentioned here is, at least in the United States, what's going to change anything is going to be incentives brought about by the markets, because insurance companies, State Farm and Allstate, are already pulling out of California because of the wildfires. They can't afford them anymore. And if we see that start to happen in many more places, then you're going to have to change building codes. We saw that happen in Florida after Hurricane Andrew. The building codes were strengthened because so much damage was done. It destroyed the insurance industry, but it did build stronger housing, and that's what's going to have to happen.
Or do people just leave, Alex, and go somewhere else?
But where? The weather patterns are going to change, right? Like to Brian's point, it's climate change that sets the table. So if the whole world gets warmer, or that just changes the way that weather patterns move. So in areas where, say, it's warmer and we can mine a crop, if you get 10 degrees cooler, you can't do that anymore. So you have to migrate where things go. And I think that also becomes a really interesting problem. So it also leads back to the government in terms of where do you wind up seeing the spending?
Absolutely. So where do you end up seeing the spending? You've got to kind of manage it. You've got to look at this and think, we need to spend clearly to deal with the long-term story, but we're going to have to spend as well to deal with the short-term story. The IRA, Alex, probably spends money to deal with the longer-term problem. Are we ultimately going to have to see government stepping in a big way as well to deal with the short-term problem?
And to that point, Mike, last to you, if what Brian says is Monday, Tuesday, we're going to see events canceled, what does that do with the impact of spending and consumer spending and stuff?
Well, it'll slow down consumer spending. Obviously, people don't want to go out, but this is, in that sense, like most natural disasters, spending is delayed or moved into other areas, but it still gets spent. And then if there is damage, there's not really going to be damage from the smoke from the wildfires, but damage gets repaired, and you end up not finding the disasters in the GDP because more money is spent on repairs than on losses. So it's a crisis for insurance companies, and they may pass that along to Americans, but it's not something that really shows up as an economic problem.
And that's a perfect segue to our next segment. All right, guys, thanks a lot. Really appreciate it. Bloomberg's Michael McKee and Brian Sullivan. So coming up, yes, we'll get more insight into the question of the day, what needs to change as New York chokes. We're going to talk about it with Ann Walsh, the CIO of Guggenheim Partners Investment Management. She's responsible for meeting the investment needs of the firm's fixed income clients. Some of those are actually insurance companies. This is Bloomberg. All right, you're looking at live pictures of New York City under a heavy blanket of polluted air from Canadian wildfires. It is quite intense. It definitely looks like you're looking at a vintage filter if you take a picture with your iPhone, just putting that into perspective. So that leads us to our question of the day. What does need to change as New York chokes? We want to ask Ann Walsh, Chief Investment Officer at Guggenheim Partners Investment Management, Chief Investment Officer, and Wall Street reporter Sonali Basak also joins us for the conversation. I appreciate that the specific question may not be in your bailiwick, but the idea of you put a lot of money to work for a lot of different clients, of which are insurance companies. As we see the actual climate changing and have more of these off events that we're not prepared for, How do you think about something like that?
Well, historically, as a fixed income asset manager, we take a very long view on risk. We've certainly incorporated ESG, so environmental, social, and governance risk management and thinking into our analysis. And this falls neatly into the environmental question. And this is yet another element of the paradigm of taking a long view. We have to think about what's really happening around the world with regard to all sorts of different risks. And quite clearly, as I'm sitting here in New York, and experiencing this tremendous amount of smoke, my eyes are tearing just like everybody else's. And we've certainly seen these kinds of very significant environmental experiences in the past, whether it's hurricanes in Florida or the wildfires that we've experienced in Southern and Northern California over the last number of years. It seems to be getting worse, and that's why we really have to think about it and incorporate it into our thinking in terms of risk management.
It's interesting because a major base for Guggenheim is in California, clearly no stranger to wildfires. And when I think back for a long time ago now, before PG&E, for example, went bankrupt, Guggenheim had actually sold the bonds in anticipation of some of these risks. What does that action have to tell you or have learning experiences from as you think about future environmental risks, as you think about trading bonds?
So if we go back to the PG&E experience, what we had was a company that had neglected its power grid and certainly with little understanding of what could happen if there was a spark or a fire that happened. And so when we looked at that company through the ESG lens, it was quite clearly evident that this is a risk that we weren't willing to take on behalf of our clients. And so we exited the bonds. Additionally, there were other aspects to that transaction at the time where that experience that involved bankruptcy and the unique elements of the bankruptcy court and the priority of payments. So all of that taken together, it was a classic example of an ESG, what I would call risk management failure. And that informs us for the future and how we evaluate companies and the risks that they're taking in their business model. A company's a real approach and the seriousness with which they think about what I would call non-balance sheet or non-income statement or revenue generating risks, but the long view and the broader environment within which we find ourselves, the larger backdrop that we find ourselves in. These are really significant as investors, and we really need to pay attention to that.
There's been a lot of conversation about inflation, is it cooling, rolling over, but there's a cross-current under the surface of whether the shift to renewables, shift in ESG spending will be another inflationary trend. How do you weigh that against what the current macro backdrop looks like?
So I think it's helpful to put in context where we are today. We've had the wonderful experience of 40 years of the bull market in bonds, and a lot of that was driven by tailwinds which were really disinflationary tailwinds. Globalization, technology, which mostly was desktop, moving into cell phones and other kinds of technology like that, population shifts. All of this was very positive. But now we've shifted, and we are seeing a different trend in globalization, quite clearly, to reshoring, friendly shoring. Investment in sustainability, which is going to require quite a bit of investment over the course of time in infrastructure and thoughtful planning there. Population shifts, again, are changing. And technology is changing as well. We're moving into the world of AI, 5G. All of this is requiring a tremendous amount of investment. And by the way, it's all, at least in the near term, going to be reflationary until the tailwinds occur again from AI, when we start to see the disinflationary or deflationary trends start to really take hold. But it's going to be a while. And again, back to my point about being a fixed income investor, we've got to take a long view.
And good morning, it's Guy in London. Let's talk about that long view. There are lots of things that are going to change as we work our way through this process. You talk about AI. That could leave parts of the population as stranded assets. We've just been talking about the environmental story. That could leave stranded assets as we see populations migrating, as we see changes in behavior in the way that we use the assets that we currently have. How much of what we currently have will end up being stranded by some of the trends that we're seeing?
That's a really great question. And this goes to the aspect of how much inflationary impact will be felt by this big transition that we're going through. It's hard to tell how much of that will be stranded or how much of it in some form or fashion could end up being recycled or repurposed. I hope that technology helps us to find solutions to that very problem, but we've certainly seen large shifts before, for example, in power. So going from the stranded assets of nuclear power plants, that was billions of dollars of stranded assets. It could be that significant again. And once again, the world is going to have to absorb these costs. And, it's going to be a challenge for a while because these global shifts they're not, a really short-term phenomenon. They can be very lengthy. They could be a decade or 2 decades even, in our view.
So to move that then into the Fed, because there's 2 points of the conversation, right? One is this broader sort of climate risk. The other is the near-term risk of what the Fed's going to do, and then how you then digest both those things for the longer term. What are you thinking?
I think it's going to be very challenging for the Fed in this environment to get inflation down to a 2% level, which is their stated goal. We may get to 3%. That's our expectation. There's going to be also economic cycles within this long backdrop of global shifts. For example, we anticipate we're going to see a recession, or at least rolling slowdowns, if you will, in the economy as we go through the second half of this year and into next year. That will help to bring down inflation in the short run. But again, getting to that 2% and keeping it there is going to be hard for the Fed. Additionally, again, all this spending that's going to happen as we make these very large mobilizations in these important trends are going to fight against the Fed because that's going to be stimulative.
Right.
So at the same time, they're going to be trying to fight inflation. The spending is going to be occurring on a fiscal basis, and it's going to be brought on by not just U.S. spending, but also global.
I'm going to be annoying and bring up a third term because we're talking about inflation, potential deflation, but just this morning we heard a word again that we haven't heard in some time. This idea that Goldman, and we spoke to their president this morning, is preparing for stagflation. That is a scary word for bond investors. How much are you actually preparing for that outcome as opposed to a traditional recession?
So we think that we're coming into this cycle, at least, with some fairly strong underpinnings in the economy. The consumer is sort of well situated. There's enough savings in the system. And even though corporations tend to be a little bit over-levered in terms of the total leverage in the system, the reality is that they're well able to cover the cost of that leverage relative to history. So a lot of this then sort of creates a support level, if you will, into the economy. So we're not really anticipating stagflation in the way we saw it in the 70s. Right now, we're expecting to have a fairly mild recession, or if you will, maybe some rolling recessions in various aspects of the economy.
So how do central banks handle that, Anne? We've just seen the RBA in Australia and the Canadians yesterday. After a pause, their banks are hiking. How much visibility do we actually have? How much of a handle on the situation do you think central banks have got right now? Are we going to be in a kind of stop-start story when it comes to central banks? And how difficult is that going to be for you and other fixed income investors to manage?
So I think this is a real challenge for the Fed. Historically, they look back to the 70s. They don't want that stop-start experience that they had then, where they would raise rates, then the inflation level would come down, they'd pivot, they'd lower rates, and then inflation would rear its ugly head again. And this pattern went on and on until Volcker finally stopped the pattern. And so as a result, they don't want to repeat that. And so it's going to be a real challenge for them. We do believe, however, that they're more likely to pause in June, or if you prefer that term, skip, and reevaluate based on data, and probably a 25 basis point hike in July. And I don't necessarily think the Fed's going to be driven by what happened with the central banks in Australia and Canada, but nonetheless, I think that they do want to, and they've signaled that they want to evaluate where we are right now with the already very aggressive level of 500 basis points that we've seen in rate hikes so far. Remember, they also still have quantitative tightening, or if you prefer, the reduction of the balance sheet going on in the background. So they're still tightening, even though they're not necessarily actively raising rates, perhaps in June.
Okay, Ann says Skip. I say hold. Guy like Skip. We compete on this quite a bit, I got to be honest. So what is the best way to hedge? Like, what's your favorite investment right now?
So we're rather moving into and have moved into a defensive posture with regard to our portfolios, moving a bit up in credit quality. And up in credit quality can mean several things. It can mean absolute ratings, or it can mean moving up in the capital stack, and getting a lot more thoughtful with regard to the credit risk that we're willing to take. Because so far we've seen a lot of action based on rates, but we really haven't seen the credit cycle start. And we do believe that as we go into the second half of this year and into 2024, we're going to start to see spreads widen, and so we're going to be really thoughtful about that. So defensive posturing right now in our portfolios is really our best idea. But the good news is that there's enough yield to be had in fixed income, even in investment grade, certainly relative to several years ago. And as a result, you're getting paid for patience at this point in time.
How far are you looking for spreads to widen before you comfortably step in? And how much do you worry about maybe a recession that's a little harder than one would expect, a loss of capital?
So it's really difficult to pick perfect bottoms and tops in markets. So we tend to migrate into markets or out of them. Right now we're migrating away from risk assets, and we will migrate back. When we see enough spread widening historically in investment grade, 200 basis points movement is a significant level of movement. That would certainly signal for us a thoughtful entry point, and then maybe quite substantially more than that in high yield.
And great to see you. Thank you very much indeed for joining us here at Bloomberg. Ann Walsh, Guggenheim Partners Investment Management CIO, and of course our thanks to the very busy Shonali Basak. Now you can catch Ann's Bloomberg Invest panel. It's taking place in the next hour, 11:30. You can of course find that on your Bloomberg terminal. Live go as ever the function. This is Bloomberg.
Militaries to say, look, we need to develop mechanisms so we can communicate with each other. We can actually signal at sea to each other, so we can try to mitigate
Rules of engagement.
The rules of interaction. This is a little different. Rules of interaction about, hey, how do we diffuse
great questions.
We're about an hour into the U.S. trading session. Stocks trading a little higher. You have the Nasdaq 100 moving higher again by 0.6% after yesterday's sell-off, and I put that very much in quotes. Abigail tracking the moves for us. Abby?
This is the volatility that we continue to have on the week, Alex. It looks like a lot of volatility, and it is, but very, very small moves. At this point right now, over the last 4 days, we have the S&P 500 down less than 0.2%. This area of congestion looks like it could break out to the upside, so tomorrow maybe an update, which would lead to perhaps a small gain on the week. Now, because of this volatility that's really in small moves, let's take a look at the VIX and the one-day VIX. There was so much criticism of the traditional VIX because it wasn't registering above a 40 last year with the sell-off, so this one-day VIX came around. We'll take a look at the one-day VIX. It's at an 8.5. The traditional VIX below a 14 handle, it's actually at 13.9. So the complacency that's associated with a lower VIX measuring uncertainty, not so much fear, is really showing. So there's not even so much uncertainty, at least per the two VIX indexes that we have here. Relative to some of the stock movers, though, maybe a little bit less certain. Carvana, certain to the upside, up 25.4%. They put up an okay quarter, but the real deal is that for this quarter, their EBITDA blew it out of the water, 50 million versus a loss of, I think, 3.6 million. This stock makes huge, huge moves over the course of this year, given the fact that it's down about 95% from its recent peak, but nonetheless today one of those moves. Now GameStop to the other side, down 21%. The CEO, the old CEO, is out. Ryan Cohen is now in. Numbers not looking great there, even though they didn't actually report earnings. A story to stay tuned to. And then Adobe up 4.2%, closer to session highs. They of course have introduced some AI products, so whether or not those are great products, AI will bring a stock higher. That's certainly happening today. And then finally, let's end on the two-year yield, because on the year, this is interesting. Speaking of volatility, now these are huge moves. You have the two-year yield basically go from 4.30 all the way up to about 5.10 into Fed Chair Jay Powell speaking right before the bank crisis, and then that turmoil taking the two-year yield back down toward 3.6. Well, Alex, we're now kind of right where we were starting off the year, a little bit higher than that, but 4.50. So
yeah, definitely a chunky move yesterday, and then a little bit of reversal today. Abigail, thanks very much. Really appreciate it. All right, it is 7:32 on the West Coast when I get to the startup. But we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. I would love to have that clear blue sky. Bloomberg Technology co-host Ed Ludlow joins us now. Ed, we just talked about GameStop just getting smoked. What's going on with that one?
It is a tale of personnel, a tale, as you saw in that image, of clouds on the horizon from the era of streaming and subscription in gaming. But what's happening is that Matt Furlong, who's been the CEO for the last 2 years, has been dismissed. And GameStop did not give a reason for his dismissal other than to say his resignation from the board was not because of any falling out between the two. You have Ryan Cohen of Chewy.com fame, who moves from being chairman to executive chair, and look, they missed on sales and they're going back to losing money. Why? Because people don't walk into a physical store anymore and buy a video game in disc format.
Ed, A, nice hair. B, why do I care about this story?
Look, I think it's a cautionary tale for the meme stock hype. You know, we write in the Bloomberg News story that, you know, GameStop was the meme stock of 2021. And Ryan Cohen came in and he's not been able to leverage that poster child or spotlight reputation into kind of meaningful business gains. You know, they've flirted with Web3. They've looked at adjusting the business model. But it also tells us what's going on in the video games industry. For example, I have a PlayStation 5 digital edition. It doesn't even have a disc drive. By the way, other consoles are available with drives or otherwise. But people just don't do that anymore. They are downloading games from online stores, or they're doing it on a subscription basis.
So, and I should point out that maybe the meme stock trade has moved on, but there is a movie to be made about this, by the way. Literally, there's a movie that's going to be made about this in terms of the retail investor, meme stocks, and Gabe Plotkin. I'm just saying that's happening. Okay, just staying with that idea, though, we know the fundamentals, we knew the hype around the stock. Who else is this bad for, either in terms of who the retail investors are going after, if they're still around to do that, or what other company is so exposed to this?
it's an interesting point. On the positive or to the upside, it's a strong signal for games like Amazon, for example, that have online gaming businesses. It is also not just sort of a universal one-direction trend. Think about Google and what happened with Google Stadia. Google introduced an online-only subscription-based gaming platform, and it was a failure. They had to shutter it and refund customers for the hardware, which was a controller, and for their subscriptions because there wasn't appetite for it. It also puts into the spotlight what's happening with Microsoft and Activision, right? Which is that content is kind of king. And when you think about how people are accessing video games through downloads, having kind of control of the store, or in Microsoft's case and Activision's case, having to offer a concession and make key titles available to rivals like Sony or Nintendo, it shows how dynamic this space is right now. On the meme stock side, I've stopped covering meme stocks, particularly on Bloomberg Technology. When was the last time I walked into an AMC theater and thought, yeah, this is a tech company, absolutely.
I don't know.
I guess that's my point. Why do we care? It was of a period in time when all the stimmy checks and everything else were being spent. Feels like we moved on from that. Ed,
right.
Thank you very much indeed. Ofcom will be very happy with you. There are other consoles available. You
Correct.
can take it out of the UK, but the DNA is still there. Ed, Caroline, a little bit later on Bloomberg Technology. Looking forward to that coming up in around 90 minutes time. Bloomberg Invest in New York is underway. Tom Keene is currently speaking with Nassim Taleb, distinguished scientific advisor at Universa. Shockingly, they're talking about tail risk. Let's take a listen.
Istanbul to northern England. One single weekend allowed COVID to travel around the world, you see. So just to give you the idea that we're dealing with different reactivities to the system. So once you know that, you realize that it makes everything fat-tailed. So when COVID came, we rushed to publish, my friends and I, in journals, in epidemiology journals, because about what happens when the process is fat-tails, why your analytics got to be different. And we realized that even epidemiologists, all right, didn't know they would make economists look good. Okay.
Well, you go after the libertarians here on a policy basis. You just say the libertarians are out of control early in COVID. I did an interview with someone in England, I think at Imperial College, I can't remember, and they had three differential equations going on. The mathematics of COVID and the epidemiology of COVID is well. Did we get any wiser in finance? Any new humility out of what we witnessed in COVID?
Let me comment on libertarians. I'm not going against libertarians, but pseudo-libertarians, because if you read the site Hayek, have they read Hayek? No, because Hayek was in favor of government intervention for deforestation, Canadians dumping stuff over New York, all right? The ashes or whatever it is.
It's not a volcano now.
And war. And the same, even von Mises was in favor of intervention. So I'm saying that there are systemic things that we got to avoid, the left tail, and let people buy whatever vacuum cleaner they want. So don't interfere in people's personal matters, and actually libertarians were against the government getting involved in commerce. They were not against the government getting involved in defense, okay, and that's a matter of defense. So I'm saying the libertarians were not interpreting their own literature, largely because it attracted a crowd of people who probably have never read books. So that was my comment on libertarians. Mm-hmm. But to comment more generally on what we have learned from COVID, the system learned a lot from COVID. We learned to use masks. We have masks. It helped me today. We learned. It's like what I describe in Anti-Fragile, the adaptability of systems to shock that don't end it. So, for example, COVID was a tragedy. Many died. But we're going to be better off because should we have a bigger threat, like something that can kill faster, we'll be ready. We have Zoom, we can continue business as usual, so we're better off than pre-COVID. Mm-hmm. And that is central. Maybe the economists are not better off than before because they're academic. Maybe epidemiologists that keep writing equations that make no sense. But overall society as a whole is stronger and a lot more capable of dealing with the threat of large-scale pandemics.
I want to review how we got here, because I think Taleb has become so big and such a media guy that people forget the absolute shock of Nero Tulip and John the high yield trader long ago and far away. There are exactly 2 books I've thrown at my children and said, shut up and read it. One was Fareed Zakaria's Post-American World, which was revolutionary at the time. And I should note that both of these guys coming out of an old world view. And the other was Fooled by Randomness. And what's unique here, folks, is this is a guy who didn't do it once, but he did it twice, 3 times, 4 times, skin in the game. Is there a book in progress here? Are we working on something?
Maybe. I'm not sure. You only know that you have a book when you finish the book. That's how it happens. And the book doesn't tell you how and when it will finish, so you follow until it's done.
It says right here, Bloomberg Invest, so we're going to get to invest part and rates here in a minute, but could Nero Tulip and John the high yield trader, could they exist today?
Yeah, of course.
In this new world?
The problem is Nero Tulips are fewer and John the high yield trader are much more numerous. So to give you an example, John the high yield trader is a typical blown-up trader. The times are different. We live in an environment where we like to take risk. We should be taking risk. We only take daily risk, not ordinary risk. So the portfolio doesn't have volatility. It's very stable, goes up, and then one day, boom, up the escalator, down the elevator, right? So these traders are more numerous today, thanks to what? Thanks to the great financial crisis and the reaction with the zero interest rate policy that really produced a generation. I say 15 years is a generation in finance, okay, a generation means manager to trainee, a whole generation of people who don't know what interest rates mean.
And it's back today.
And now they don't know what. So what happens? There's shell shock. I mean, think about the past. Even negative cash flow businesses were selling you future cash flow. They were selling you, saying, "Okay, we're going to lose money, and then later on we'll make money." Today, right before this crisis, what were they selling you? They're selling you, "Yeah, we're going to get someone to fund us." So they're selling you funding. It resembles a Ponzi. Okay, who cares about money? And they were using the third round and whatever mechanism they did to fund themselves as a cash machine. What, negative cash flow? What, you want to buy a printer? Okay, funding. What, we need to buy a new plant? Funding. So we had an environment where that notion of everything you can learn from the great investors or wise people such as Warren Buffett and others, anybody with gray hair would understand that your oxygen is cash flow. Okay, you can have negative cash flow, but you know that it must be compensated later on. And they forgot, they don't know about it. So this is why you end up having tumors, such as Bitcoin.
We'll get to Bitcoin.
And sorry?
He's like me, he doesn't like it. Okay.
Okay.
We'll get to
but something that you take for granted, real estate. Mm-hmm. Real estate is even worse.
How bad is it going to be? Cut to the chase.
Think about it. 120, 30 billion, $1 trillion dollars created during, in value, in valuation. That's valuation. That doesn't, if that doesn't go down by half or 3/4, there'll be something wrong in the way we understand finance, because you cannot carry a house if your income is $30,000 a year. You cannot carry a house. You could carry in the past a $500,000 house. Now you can't anymore. So you got to calibrate to that. Eventually, the real estate will adjust unless you have inflation. And I don't think they have too much appetite to let inflation run.
How long is it going to take us to relearn of real interest rates, of an interest rate, of a legit Sharpe ratio, of a risk-free rate that matters?
I mean, what happened, there's a cycle. So the John across the street from Nero Tulip, are now in the process of either dying. A lot of them are dead, but they don't know it. That's what happens in finance. Or like everybody knows you're bust except you. So So a lot of these VC, so there are two sectors you have to worry about: real estate and that pseudo technology. All right, all this, the non-sound technologies that absorb so much money. I don't know which is going to be the first shoe to drop, big time.
I look at the dynamics right now, and we've been shocked on Bloomberg surveillance at the certitude of the end of the year. They got that wrong, just like the dollar call.
Yeah.
Dollar's going weaker, guaranteed dollar's going weaker. Can mere mortals have a plan now? Can they have, just with an ERISA 74 and the complete failure of our retirement system, can mere mortals save for retirement? They're not fancy like Universa or Spitznagel or Taleb. Can they have a plan?
Well, the problem is that, and again, that's a culture that a lot of people partook in the creation of such culture. It was not just the brokerage houses and the entire industry, that you must make money out of your money rather than you must preserve your money, you see. And that drove people to invest and think that they don't need to save a lot of money because their investment will take care of itself. And now we're facing a hard reality with pensions severely underfunded, with Social Security. Let's not talk about it, but you understand what I mean, okay? We have, and the stock market will be unable to deliver the promises that they have on paper. So we are in an environment where, if the new environment, people try to make money out of their business and preserve that for retirement, rather than try to make money out of the retirement business, and their day job is some kind of, a footnote in their life.
Do you just assume that the actuarial assumption will go up if we're going to move from zero rates up to wherever we head, that the entire pension industry is going to see an actuarial rate pop up here? I don't think people really have gauged that.
No, people don't realize that with interest rates up here, that you not only you have higher requirements of what you need to earn from the market, but at the same time, the market got to adjust to that new discount rate. So they're hit on both sides. The whole notion of prudence. I mean, we're in the business of prudence. Mark, myself, maybe you, the business of prudence. And you keep fighting the winners, because usually the winners are the foolish risk takers, and then they disappear and nobody hears about them, and then new winners come in. But we keep fighting for prudence. But at an individual level, someone got to teach people that if you're a butcher, focus on making money selling meat, okay? Don't try to make money from, if you're a dentist, dentists are a problem because they all want to make money with gold, speculating with gold. Anyway, so if you're a dentist, focus on make money drilling teeth and preserve. Focus on preservation, not making your money work with stuff like that. So we need to change the general culture.
We'll do a chart here in a minute, but I got to ask you, what did you feel like the day Credit Suisse blew up? You had a huge heritage there.
Taleb, Distinguished Scientific Advisor at Universa. Speaking with Bloomberg's Tom Keene at Bloomberg Invest. Definitely follow that conversation. There are a lot of great panels also coming up. We'll take some live in the next hour. In the meantime, you can go to Live Go for Bloomberg Invest for all the panels there. All right, coming up, we're going to take a look at Twitter and what the founders think about Elon Musk and his reign at the embattled social media company. This is a conversation you don't want to miss. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Yahaira Jaquez. A blanket of heavily polluted air covering much of the eastern U.S. is likely to linger until Tuesday as the impacts of Canadian wildfires ripple south. Inbound flights to New York's LaGuardia Airport were grounded briefly again today due to low visibility. Meanwhile, the National Weather Service said the Philadelphia and Baltimore regions are facing the worst air quality in the country. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam. The regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is in Russian-occupied territory. Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. At a Pride Month celebration tonight at the White House, President Biden will announce new federal efforts designed to counter state and local laws targeting the LGBTQ community and book bans. The Department of Homeland Security will undertake a new program that offers safety training to LGBTQ community centers that have come under increasing threat. Global News 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Yahaira Jaquez. This is Bloomberg.
All right, Yahaira, thank you so very much. We have a special programming note for you today. It is the debut episode of The Circuit. It is a deep dive into major areas of the technology market with Emily Chang. On the premiere episode, she speaks with Twitter co-founder and former CEO Evan Williams and Jason Goldman, a founding member of the team, and she asked about their first reaction to Musk's takeover of Twitter.
Yeah, it was surprising. I mean, I'm trying to remember the first bursting on, or if I was even aware of it. Were you?
The idea that he was going to buy the company, to me, initially seemed like, oh, he's not going to be really serious about this. It's going to be like the way you sort of, you know, put in a reservation on like a fancy sports car.
There have been a couple moments where I'm like, oh, I started this thing with some other people a long time ago in this little office, and then the world's richest man bought it. Right. And it's this big news story. I'm like, how did that happen? That's weird.
Was there any part of you that was like, oh, this is interesting, maybe it's a little exciting?
Totally, yes. I like interesting things to happen. Right. I'm not a fan of things staying the way they are. I mean, that's why we do tech. That's why we start new things. Twitter had been getting better and better. Actually, the trajectory of improvements in the year or two prior to Elon. But then it was like, Elon, holy moly, he does crazy things. This will be interesting and fun. We'll see what happens. Yeah. We may differ on this point.
Yeah, I mean, I was just concerned because like everything he was talking about that he wanted to do with the product seemed pretty lightly considered. We got to defeat all the bots and, you know, there's all this stuff about like the culture wars. But it became clear over time that no, that is his primary interest in owning the platform, is the kind of push on these particular cultural issues and his own personal use of the product he wants to make better.
So how do you feel about what he's done so far?
I don't think he's dialed it in quite right yet.
Well, it's gone pretty poorly. I mean, just objectively speaking, the moves fast sort of mythos is belied by that most of the things that have been pushed out the door, like Twitter Blue or view counts, make sure you amplify my tweets so that everyone sees them, which is, again, if you own the product, you can do that. It's just a curious way to product manage a global platform.
A Bloomberg original. Emily is out from behind the desk. She's on the road. She's catching up with some fantastic people. The rest of the series is going to be amazing. You can catch the rest of that first interview of our new program, The Circuit, every Thursday. They're going to be on at 10 p.m. Eastern Time on Bloomberg Television. You can also watch it, of course, on the Bloomberg app. You can find it, of course, on Bloomberg.com. It's going to be fascinating to watch. And as Emily kind of evolves her way through this conversation, Alex, I think it's going to be really interesting to hear what she and her guests have to say. I think a mixed opinion there on how Elon's getting on so far.
Yeah. That's being generous, I think. I should point out, Guy, we do have the Air Index Quality Index from New York is below 200 now. I just want to point that out. I feel like this is going to be the conversation tomorrow as well and throughout the weekend. It's still in red territory, but, you know, it's better than purple. So it looks a lot. It does look a little bit better there.
So you're running too much. I saw Dyson, and I know a number of other manufacturers are coming up with similar devices as well. Headphones and a breathing device. Maybe that's what we're all going to end up looking like fairly soon, if this is the direction of travel.
I mean, yeah. I remember when we saw the headset with the mask, we're like, who would wear that? And then today it actually looks like a really, really, really good thing to have, to your point.
Absolutely. We'll wait. Maybe it's not ahead of its time. Let's talk about what's happening in the markets right now. The Stoxx 600 absolutely unchanged. Again, stock market at a headline level, boring, nothing to see. The move in the currency markets is fascinating. Look at this big move against the dollar for the Swiss franc and Ørsted. So looks like it's not going to raise money, up by 5.27% on the back of that, but also the first energy company, I think worldwide, to issue a blue bond. This is basically a bond that is designed to ensure that the marine environments are protected. Fascinating first step being taken. A European close is coming up next. Monica Defend, head of the Amundi Institute, is going to be our guest. Lots to talk about there. We need to talk about the European economy. That's all coming up. The close is next. This is Bloomberg. Thursday, June the 8th. Boring, nothing to see here. We talked about football yesterday. I'm not sure what I'm going to talk about today. Certainly the weather is dominating the headline in New York. But equity markets kind of just going sideways. We're waiting for something to happen. Other asset classes are much more interesting. Take a look at what is happening in the currency markets today. Take a look at what is happening in the bond market today. Single stocks are also interesting. There is lots to talk about, despite the fact that at index level, there isn't. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.